I'm Howie Lim. This is Money Hacks by the Business Times. You know how we're always told to stay invested and have a long-term view, i.e. staying invested for the long run, long-term investing, 5 to 10 years, don't be a trader, you don't know what you're doing, etc., etc. Okay, rude. So you get the idea. But it seems thanks to the current volatile environment, there's a camp starting to ask whether long-term investing is still ideal because things are so uncertain. I, for one, don't like paradigm shifts. Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And if you have feedback or an idea for a podcast episode, do get in touch, btpodcasts@sph.com.sg. And helping us out today is Yee Shen Hao, Financial Services Manager at Phillip Securities, and Tan Chin Yu, Lead of Advisory Team at Providend, who starts off with his view on the viability of long-term investing.
I would say 100% that long-term investing still makes sense for the average investor today. In fact, even more valuable during this uncertain time where actually you really don't want to do short-term investing, right? But that's provided that you're investing sensibly. And what I mean by that is that you want to have a diversified portfolio of equities and bonds. And these instruments actually derive their returns from economic drivers. You want to get returns from actual companies that sell goods and services and making a profit. Why this makes sense is because, firstly, the markets have always faced some kind of uncertainty. Today, we have concerns about the tariffs. Many years ago, it was inflation, it was COVID, the Great Depression in the 1920s. That was one situation that was very bad for equities. But history has showed that despite all these, wars, recessions, geopolitical tensions, or pandemics, markets generally trend upward over the long term. And this is so because we are investing again in real companies and economies that have been very resilient in the long run to find a way to stay relevant and to navigate around different crises that they might encounter.
Economic data is backward-looking and stock market prices is forward-looking. So investors should not act solely based on economic data. For long-term investing, we typically define it by 5 to 10 years or more time horizon. It remains one of the most reliable ways to build wealth because historically 5 to 10 years covers about a full market cycle. It allows time for recovery from downturns and let compounding work for investors. So investors have a higher chance of positive returns and reduced risk if they hold a long-term investment strategy. For younger millennials and Gen Z investors, those in their 20s and 30s, right, they may have only started investing, most of them, after the 2008 financial crisis. They have actually enjoyed relatively long bull market. And the strong market growth since 2008, led by the US, is closely tied to the low interest rates in the US. And also the 4 rounds of quantitative easing, which is the printing of money. So historically, bear markets before the 2008 crisis were a bit longer and deeper compared to the downturns since the 2008. And post-2020, there were pandemic policies that helped to reignite the markets. So the Feds have become more preventive rather than reactionary like prior to 2008. But I think this period has been exceptional. We are now shifting back to pre-2008 era, where the interest rates are normalizing, reverting to the mean of 3 to 4%. So volatility is now the new norm. Investors should accept that markets are up and down. It's part of the new normal.
That's Yee Shen Hao from Phillip Securities, and it looks like long-term investing is still possibly able to help investors ride out the ups and downs of the market and hopefully achieve stronger returns. So why is its efficacy and validity being challenged? Maybe we're not understanding this. Oh, misconceptions is the fancy word for it.
One of the misconceptions is that volatility means that my long-term plan isn't working. Because short-term market swings, especially like over the Liberation Day, right? 2 or 3 weeks after, the markets actually were down about so much as 20% in the US. So people might mistake that as a sign that long-term strategy is failing. But volatility is actually a feature, not a bug, of the stock market. It is a normal part of investing, and long-term plans are designed to withstand short-term fluctuations. Also, there's a misconception that it's safer to sit in cash during uncertain times because holding cash you might feel more secure, right, as an investor. But over time, if you hold for too long, it can erode your purchasing power because of inflation. So staying invested, even conservatively, is typically more effective than trying to time the market. And of course, one other thing is that long-term investing means doing nothing. Like they can just buy and hold and forget about it.
One misconception I see from investors is that they must do something to their investments. Like I said, put your money in a Milo Kong in a volatile situation. I would say that's normal. Investors tend to feel the urge to jump out of the market and wait until things feel safer before going back in again. But the reality is that the markets are very efficient. If something happens, the market very quickly prices in that new information, and markets are always forward-looking. And in fact, recently this example of markets falling after Liberation Day, it's actually a sign that it is working as they should be and constantly pricing this expected return for the investor because it still needs to make sense by accounting this latest expectation. I would say the other misconception is that I find that people think that long-term investing applies to everything as a broad concept. Long-term investing, it makes sense only if you're investing in the right instruments. Yeah, otherwise you could be holding on to a bad investment, and holding for the long term can mean that this bad investment can continue going down over time. And lastly, one of the things that I see about having a long-term investment strategy is that for an investor, you don't want to completely ignore your wealth plan. So what I mean is that you could already be invested in a sensible portfolio with a long-term strategy, but you always still want to keep an eye on whether there could be situations that might impede your ability to stay invested for the long term.
Oops, I might be 4 for 4 when it comes to misconceiving what long-term investing entails. Still to come, what asset classes are or aren't appropriate for long-term investing, and where should we turn to for stability in volatile markets? More with Tan Chin Yu from Providend and Yee Shen Hao from Phillip Securities in a moment.
Breaking news from the Business Times podcast team.
Hi guys, this is Emily Liu, your host of Market Focus Daily. I've got some great news. Come July, Market Focus is getting bigger. I'll be bringing in market and investment experts into the studio to share analysis and opinions on what moved the markets and what to look out for in the week ahead. Every Friday, starting on July 4th.
Look out for Market Focus Weekly from the Business Times or wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
But in reality, successful long-term investing requires regular portfolio reviews.
So good times, investors often forget that market downturns happen. Again, do remember to regularly review your investment and financial plan.
Whoa, that's advice on reviewing your portfolio regularly in stereo from Tan Chin Yu from Providend and Yee Shen Hao from Phillip Securities. Roger that. We've been discussing whether long-term investing is still ideal in volatile times, and let's tackle the what's good for long-term investing in and what isn't.
Historically, if you look at 20, 30-year data, US equities, especially large companies, defined as above 10 billion in market capitalization, has outperformed other asset classes and most other geographical regions, and also other asset classes like commodities and bonds. For investors who have a long-term investment time horizon, traditionally, the thesis is that US has an exceptional performance. But there are, of course, in recent times, questions put up about US exceptionalism because of how Trump is shifting the focus away from a global trade system to one that is more American first. I will hesitate to tell you moving forward because I can't crystal ball in the future. Traditionally, based on past performance, equity markets have outperformed other asset classes.
Yee Shen Hao from Phillip Securities' vote goes to the equity market. And what does Tan Chin Yu from Providend think? Anecdotally, some feel doing nothing may be the best because by moving too quickly to sell assets, you may run the risk of missing out on seeing your portfolio recover from falls and even grow in value.
So in terms of asset class, I would say equities still make the most sense for long-term investing, as it has historically been the most reliable in generating sufficient returns in the long run. And this reliability, again, despite market uncertainty, comes from the fact that equity returns are driven from actual economic activities, from companies selling goods and services and then earning a profit and hence rewarding shareholders. And as an investor, you are participating in this economic engine that has survived all kinds of crises. So even with an example of a world war, companies had to pivot their business to sell, military equipment, for example. And it is always still the whole objective to generate a profit eventually. But that's it. It is true that in the short term, equities do come with this volatility, where again, it's always trying to price in and digest new information. So if you need higher certainty or lesser volatility in this shorter period, then you want to have bonds in your portfolio as an asset class to cushion some of these uncertainties.
One way that investors can position their portfolios, and increasingly we are seeing a lot more investors they are maintaining a core portfolio of perhaps index funds and ETFs, but they also have a smaller proportion in what we call a growth portfolio, where they actively rotate trending sectors like AI, energy, or tech. And for younger investors, they are more likely to also explore alternative asset classes, including crypto. Yes, the traditional view of especially older investors is that crypto as an asset class is questionable, but there is a rising recognition of cryptos. For example, Coinbase was just added to the S&P 500. So in terms of utility of cryptocurrencies, it remains to be seen whether it will become mainstream. But as an asset class, it is here to stay. Gold can be seen more as a safe haven asset. But in the absence of crisis, if you look at a longer term period where bull markets happen about 2/3 of the time, bear markets happen about 1/3 of the time.
Ooh, we're moving into how investors can rethink their time horizon or rebalance their portfolios in the face of constant volatility.
So I actually don't think there's a need for investors to rethink their time horizon or rebalance just because of volatility. Because like you said, you can always expect volatility. And when an investor has invested from the start, they should have factored in this expected volatility. And it should have matched the right asset allocation to the correct time frame and their risk tolerance. So if that's done correctly, whether in good times or bad times, you can then stick to a consistent plan to reliably achieve the returns that the investor needs in the long term. But that said, I think this volatility can serve as a good reminder for investors to review some of these fundamentals of their investing strategy. So for example, whether you're diversified enough or whether you're overly concentrated into a particular sector or country like the US. Especially US have done very well, and sometimes it causes investors to forget that there are certain concentration risks. So now is a good time to think about these things, or whether you have enough time horizon to weather the potential market downturns or even a recession in the coming years. So good times, investors often forget that market downturns happen. Again, do remember to regularly review your investment and financial plan. And then when something like this happens, you can then, avoid making these sort of knee-jerk reaction or tactical changes. Focus more on the financial plan and ensure that the short-term needs are taken care of so you can invest for the long term. And again, same message I want to say is that consistency is very key when it comes to investing.
Takeaway order Money Hacks 224 is ready. Keep calm and stay invested, they say. Easier said than done, I reckon. Before you dive head first, take a peek at your wallet and where you are in life. Remember, your money moves should always bow down to your life's grand adventures. Sounds nicer than life stage. And think of crises as a cosmic realignment. Don't let those juicy opportunities slip away. The financial choices you make today could be your sanity savers when the next storm hits, because let's face it, chaos loves to surprise. A big thank you to Yee Shen Hao from Phillip Securities and Tan Chin Yu from Providend. I'm Howie Lim, and this has been Money Hacks by the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.